Here's the blunt headline up front. After leaving the White House in January 2021, Jared Kushner raised roughly $3 billion for a brand new private equity firm, including about $2 billion from Saudi Arabia's Public Investment Fund. That single fact, reported by the New York Times and corroborated by outlets like the Wall Street Journal and Bloomberg, translates into a simple, steady payoff. At a typical 1.5 to 2% management fee, affinity partners would collect about $45 to $60 million a year in fixed fees before a single investment wins or loses. The natural next question is how a first-time fund manager got checks that big, that fast, and what the people writing those checks expected to get in return. The timeline moves quickly. Kushner leaves government in January 2021, sets up affinity partners in Miami, and spends much of that year meeting sovereign wealth funds in the Gulf. By spring 2022, the New York Times reports that Saudi Arabia's sovereign fund approved a $2 billion commitment over the objections of its own advisory panel, which had flagged Affinity's thin track record, elevated fees, and public relations risks. Crown Prince Mohammed bin Salman overruled those objections and greenlit the deal. The official rationale was returns, of course. The practical result was a launchpad. Once one marquee investor commits, others take the meeting. What most people expect next is a story about brilliant stock picking or access to special deals. The quieter truth starts earlier, in the way private equity is built to pay the manager first. Bain & Company and PitchBook have described the standard 2 and 20 model for years. A fixed management fee paid annually on committed capital, plus a performance slice called carried interest if the fund clears a profit hurdle. On $3 billion in commitments, even a trimmed fee of 1.5% nets $45 million a year for the management company. That money arrives like clockwork to cover salaries, offices, travel, legal, and yes, owner payouts, regardless of whether the portfolio is up or down this quarter. So, how much of that did Kushner personally pocket? We don't have his tax returns, but industry surveys of private fund CFOs from firms like KPMG and EY suggest that once a first-time outfit stands up its team and systems, the management company's margin on fees often lands between 30 and 50%. Apply that to 45 to 60 million in annual fees, and you get a reasonable working range, perhaps 13 to 30 million in annual operating profit. If Kushner owns and controls most of the management company, as founders of debut funds typically do, his personal draw from fees to date would plausibly sit in the $10 to $20 million per year band since 2022. The carry is the big lottery ticket. And here again, the timing matters. Affinity began deploying capital in 2022 and 2023, making growth and venture-style investments in technology and financial services. Performance fees only crystallize years later, after cash is returned and profits are counted above a hurdle. If, hypothetically, a $3 billion pool returned, say, a modest 1.5 times gross over a decade, a scenario, not a forecast, that'd generate about $1.5 billion in gains before expenses. 20% carry on that, less fees and netting effects, could leave hundreds of millions for the general partner over the life of the fund. This is where the stakes sharpen. When most of your early cash flows come from the fee stream, the identity of your limited partners matters as much as your deal pipeline. The controversy isn't just the size of the Saudi check, it's the context. The Times reported that the PIF's own panel cited unsatisfactory due diligence and reputation risk, and was overruled. Meanwhile, the Wall Street Journal and others have noted that total affinity commitments climbed toward $3 billion as additional sovereign money joined, reflecting relationships Kushner cultivated during and after his time in government. If walking through the actual numbers like this helps you make sense of what's signal and what's spin, consider subscribing. We try to keep these stories grounded in the math and the paper trail, not just the headlines. And that support lets us keep pulling the next thread. Here's the turn most people miss. The flashy headlines are about potential future profits, but the guaranteed cash is the fee stream paid by foreign state funds right now. That's why the Saudi Investment Committee's early objections matter in hindsight. They shine a light on a choice to accept reputational risk in exchange for a strategic relationship. If walking through the actual numbers like this helps you make sense of what's signal and what's spin, consider subscribing. We try to keep these stories grounded in the math and the paper trail, not just the headlines. And that support lets us keep pulling the next thread. Here's the turn most people miss. The flashy headlines are about potential future profits, but the guaranteed cash is the fee stream paid by foreign state funds right now. That's why the Saudi Investment Committee's early objections matter in hindsight. They shine a light on a choice to accept reputational risk in exchange for a strategic relationship.